Okay. Hi, everyone. Thank you guys for joining me today. It is 12 o'clock Eastern, and my name is Justin Carbonneau. I'm going to walk you through some of the tools and features on Validea. For those that may not know very much about Validea, Validea is a quantitative investment research firm. We develop investment strategies here, and those strategies are utilized to do a lot of different things. You can analyze stocks and ETFs with the strategies that we run, or you can find new investment ideas or follow investment strategies with these models. And we're going to focus mostly today on the investment idea side of the tool, I guess, that we run. And there's a number of ways that we actually do that on Validea through the various strategies that we basically model here. So where I wanted to start was on a very popular tool on Validea, a very robust tool that a lot of investors use, and these are our model portfolios. So on the top nav, if you click into portfolios, I'm just going to click on all portfolios here. What we've effectively done on Validea is we track 10 and 20 stock model portfolios that are built on investment strategies that we've extracted from books and or academic papers. So when Validea first started, we were tracking strategies based on great investors, people like Warren Buffett, Peter Lynch, Ben Graham, and others. And over the years, we've continued to look for and identify other investment strategies with long-term records of success. And once we capture one of these strategies at Validea, we can then build model portfolios of stocks that pass or score or rank the highest according to each one of these investment strategies. But before we look at a model or two in detail, let me just explain some of the unique things on this page. So the first thing is on Validea, we build and track 10 and 20 stock model portfolios. And the reason that it's 10 or 20 stocks is because we want these portfolios to actually be investable for the investor. You know, some sites that have various screens or portfolios they run, they may only hold one or two stocks at any given time. Well, that's not really a implementable investment strategy for most investors. So what we're doing is we're saying, okay, for each of the model portfolios we run, we want the portfolio to hold the best 10 or the best 20 stocks on each rebalancing date. And I'll explain what I mean by rebalancing in a minute. We follow on Validea portfolios, or we track, I should say, portfolios that are rebalanced monthly, quarterly, annually, or tax efficiently. And the nice thing with this webinar today is we just did a monthly rebalance. So at Friday at 11 o'clock, we rebalanced our monthly portfolio. So what you're going to see is the most recent list of stocks for the strategies we look at that score the highest and pass that particular model, because the rebalancing was actually done today. We do our rebalancings on a 28-day cycle, and they're always on a Friday unless Friday is a holiday. And then here you just have, you know, your standard performance statistics, so you can sort of see how these portfolios have performed over time. So some of our portfolios were rolled out in 2003, others were rolled out after as we added strategy. So just keep that in mind as you look at some of these numbers and you see the performance. You should also kind of take into consideration, obviously, the inception date on all of these strategies. Like the twin momentum strategy, you know, that wasn't something we had pre 2008. So that performance number, you know, doesn't take into consideration the decline, obviously, in the market in 2008. Just one last thing, maybe before we look at the portfolios here, when you see the word optimal being used, which is what we default to, we're basically showing you on this page for each of the portfolios what size portfolio and what rebalancing period works best for that particular strategy. So as you can see, for the twin momentum investor model, it's the 10 stock model with a monthly rebalance. With the value composite model based on Jim O'Shaughnessy's work, it's a 10 stock portfolio tax efficiently. And I'll talk about what I mean by tax efficiently in a minute when we get into that strategy. So depending on the model, you know, various size portfolios and various rebalancing frequencies. Generally, and it's not true in all cases, but momentum and growth strategies tend to work better when they're rebalanced more frequently. And value strategies tend to do better when they're rebalanced a little bit less frequently. Obviously, depending on how the investor is implementing this, what type of account, you want to be thoughtful and mindful of the rebalancing. If you're managing your portfolio and IRA money, then maybe a monthly rebalance doesn't, it's not going to have any taxable implications, where obviously a taxable account would. The gains would be, short-term capital gains for the most part if you're following a monthly rebalance. So let's look at a couple of these strategies in a little bit more detail here. I clicked on the name Twin Momentum. So when you come into each of these portfolio pages, now mind you, they're going to look very similar. So the look isn't going to be any different. Obviously, the information that you find in each page is going to be very different. Here, again, this is the Twin Momentum 10 stock monthly rebalance portfolio. Obviously, this strategy, based on the chart, pretty nice outperformance even coming into the pandemic. But then since the pandemic, and this is true of many of the models that we run, things have kind of gone parabolic here with some of our strategies. So, a lot of the excess returns have really come in the past year. But for each of our portfolios, we show the long-term performance chart. We show the full return history as you come down. So if you want to see year by year performance history here, you can see that years that it did well, years that it didn't do well. We do show you the beta and the accuracy. And what we mean by the accuracy is how many stock picks in the portfolio over time have been positive winning positions. So what you'll find that's interesting is even some of our best performing models, they're only getting, let's say 50, 55, maybe in this case, 58% of the picks right. The other 40% of picks are actually not making money. But that's a characteristic of any investment strategy. You're not going to bat 90% on your investments, but you hope that the better ones outperform the losers, and so you get the excess return over time. As we come down the page, here we're seeing what's in the portfolio as of today. Let me make my screen just one size smaller so we can see the whole portfolio. These are the current holdings. Now, some of the holdings have been in here for a while. So let's look at this one, like Medfast, that was added. Oh, that was just added in April of this year. But as you can see, there are some positions here that were added last year. This one's up 246%, so that's good. That was added in April last year, pretty much right at the low. And then as you can see, these to be determined, the reason the performance is because we just added those companies today in the model. On each portfolio page, you can switch between the performance view and the fundamental view. So if you want a quick if you're following a portfolio and if you want a quick snapshot, it's just saying what types of stocks generally does this company, does this strategy like? You can quickly change that view. And then what you can see here is, some more fundamentals: the market cap, the PE ratio, EPS growth, fundamental momentum, relative strength, and shareholder yield. Remember, the reason these stocks are in this portfolio is because they are the highest scoring stocks according to the Twin Momentum strategy. We haven't even really talked about what the strategy is. And that wasn't the purpose of this, to go into any strategy in detail. But that's a key thing to understand, obviously, is that the reason these stocks are in here is because they're the highest scoring stocks according to the model that is powering this portfolio. So let me just click it back to performance here. The other thing that we have on this page is you can go back at any rebalancing date in history and see how the portfolio was positioned at any given time. So the reason that might be valuable is, if you go back to big transition points in the market or big market downturns, it might allow you to see how the portfolio did sort of underneath, a layer down from just like the performance number. What stocks were in here? Did some of these stocks absolutely blow up, and were they down 80%? Or even in periods where, coming out of the pandemic with the low in March, you can go back and see how this portfolio was positioned. I mean, that's probably more detail than most investors are interested in, but I'm just pointing out that it exists. Okay, let's go. I just want to show you. So that's all the portfolios are going to look, all the portfolio pages are going to look similar to that. I did want to highlight this value composite model. And actually, before I do that, let me just scroll. So these are all the models on Validea, all the stock models. So there's quite a bit. And it ranges what I would consider from deep value all the way to like more pure momentum. So depending on the type of investor you are, you want to kind of key in and find a strategy that you believe in, understand, one that makes sense to you, one that you think you can have conviction in to follow over time. Because, ultimately all these strategies will go through periods where they don't work, and many, they all have. Every single one of these models has gone through a period where it hasn't worked. And sometimes that is very difficult for investors to deal with. So if you're doing this on your own, you want to find strategies that you have 100% confidence in and that you can stick with over the longest period of time to give you the best chance of success. But in terms of highlighting the value composite model, the reason I wanted to bring up this one is because this model performs best using our tax efficient rebalancing approach. Now, I believe, based on what I know, I think we're the only model quantitative driven firm out there that does something like this. So this was developed, and as you can see, again, this model it's not like the twin momentum, but it had pretty good outperformance, and it took a big hit, but now it's gone kind of crazy and done really well over the last year or so. But what makes this model unique is, or the tax efficient model is unique. And for each of our models, there is a tax efficient model. It's just this one with O'Shaughnessy's value composite strategy. It tends to work best under a tax efficient rebalancing. And what I mean by tax efficient is we are still rebalancing the portfolio and we're still removing positions, but we're doing it in a systematic tax efficient way. And what I mean by that is we review all the positions. We only sell a stock in the portfolio if we have a short-term loss or we have a long-term gain. So if we have a short-term gain, when we're selling when we have a short-term, when we have a loss on it, or a long-term gain, and the stock doesn't pass the strategy highly anymore. Those are candidates to sell. We will hold stocks that we have winning positions on until we hit the 12-month long-term capital gain threshold date. So that's important because that basically means using a tax efficient rebalance model for people with taxable money, you can deploy strategies like this and do it relatively tax efficiently. Of course, it's not going to be as tax efficient as like an ETF where you're just buying the S&P 500 and holding it forever, because ultimately the winning positions that become long-term gainers, those are going to be taxable transactions. But the point is this is a systematic way to follow a model like this and not just have sort of this really high amount of turnover, which generates a high amount of taxes. It allows you to do it in a way that sort of optimizes the tax efficiently. With all these models, it's very important to rebalance because we're scanning and sorting through thousands of companies. And so there's an opportunity cost of not getting into the top rated stocks, but you have to balance that with when you're deploying taxable money with sort of the tax drag. And so this is the tax efficient models are a way that we can do that. So that's the model portfolios. On the stock selection side, I'm going to show you ETF model portfolios in a moment, but let's just stick with stocks for now. The other way that you can source investment ideas using our system is through the Guru Stock Screener. So obviously with the portfolios, if you're following a portfolio, you're buying a basket of 10 or 20 securities. But some people really want more flexibility. They want to say, okay, I want to see all the stocks that score highest according to a particular strategy. Or I want to blend strategies together. Or I want to focus on a particular industry or sector. Or I want to add in my own fundamental filters and criteria. And that's essentially what this Guru Stock Screener allows you to do. So the first thing you can do is you can say, okay, I want to see all stocks that pass highest according to a particular investment methodology. So let's just go down here to the PE growth Peter Lynch strategy based on One Up on Wall Street. And let's get stocks that pass with strong interest only, which is generally speaking in our system 90% or above. So there's a big long list of stocks, probably way too many to work through or deal with, but it's a starting point. It basically says, okay, Lynch, who basically looked for growth at a reasonable price type securities, use the PEG ratio, likes to see, other fundamental factors. We can start here and we can start trying to find stocks that meet the Peter Lynch model of investing. And let's say, well, okay, but we have way too many, but let's also let's filter the list even more and say, well, but I want more consensus among the gurus. So I want to see stocks that pass the Lynch model as the base, but they pass maybe 3 other guru strategies with either strong interest or strong or some interest, which is 80% or better. So when we add this in, you can now start to refine the list. It's still long, but you're starting to get more. But let's do this. Let's do like 6 strategies, see what we get, so we can get this list down. So we're going to really tighten it up here. Probably not strong. There we go. So now we got, a manageable, this is probably like 40 names or so, might be give or take. So now we got, we're starting to get down where it's, workable, where we can really try to identify investment ideas. Then if we want, we can concentrate on a specific sector. If we want to see just the technology stocks in here, if we have a tech orientation. So there's a few: Applied Materials, Aero Electronics, Insight Enterprises. Or if we come back up to all sectors, maybe we have a bias towards dividend paying stocks. So you can add in a dividend yield of a minimum of, let's say, we'll just say 2%. So here. So, what we did is we added, a few criteria, and we got a list of the highest rated Peter Lynch stocks, and we got it down to, maybe 10 or 12 names here. Fidelity National, Harvey Furniture, Jeffries, MDC Holdings, Rio Tinto, Aflac, Allstate, Best Buy, T. Rowe Price, and this ADR. So that's a way you can use sort of these predefined strategies, these guru strategies. You can mix them together. You can find stocks that pass multiple strategies. And then we have a host, I think, of interesting different criteria that can be incorporated in. I mean, things like enterprise value to EBITDA, the acquirers multiple, value composite percentile, the long-term PEG ratio. Coming down here, actually, I know it's in the quality and ownership. So we have 10-year average return on equity, 10-year average return on capital, weighted average cost of capital, the F score, which is from Piotrowski, the G score, which is from Mohan Ram, a quality composites. So there, for those investors that are really into, trying to use unique variables and really find great investment ideas, I think there's a lot of custom things that can be done with the Guru Stock Screener to, further refine lists and find those companies that are really worth your attention and maybe your money. So that's the Stock Screener. I'm going to now pivot over to our ETF model portfolios. So we looked at the stock model portfolios. Well, we also run what I would consider like more diversified ETF strategies and risk managed ETF strategies. So these are, obviously going to be lower return over time, probably less risk. And we're kind of getting away from the guru models and we're using more factors. So in the investment landscape, there's things like the value factor, the momentum factor, and other factors that you can use to try to identify good, areas of the market to invest. And so we have factor rotation models that combine basically, we're looking at what factors in the market are most appealing. We then have sector rotation strategies. So what sectors in the market are most appealing based on the value factor, momentum factor. And then we run them long only and with trend. So there's a trend overlay. And then coming down the list, we have what I would consider reduced risk strategies, which are alternatives maybe to something like a 60-40, and utilize different techniques to buy various ETFs. So let's just step into one of these just so you can see and get a sense of what this is. Again, I don't, maybe it's not a good, as I mentioned before, I wasn't going to talk about what goes into these strategies, but since we're here, let's just talk about this one real quick, since I brought us into here. So this is a strategy called protective asset allocation. It basically looks at 12 different ETFs across a wide range of asset classes: stocks, bonds, international stocks, emerging markets, long-term treasuries, high yield bonds, corporate bonds, commodities, and gold. And it basically brings us into the 6 different asset classes that are exhibiting the highest price momentum over the intermediate term. But this strategy also has the ability to move to crash protection in the event that the majority of the assets are in a negative trend. So these are just, this is a portfolio that is run. Did we make any changes? We didn't make any changes to the portfolio today. The last time we did make changes was on the 28th of, okay. So, well, I don't know. It doesn't look like we made any changes to the portfolio today based on this. That's just telling you when the last rebalancing is today and the next rebalancing is on the 25th. But as you can see, all these positions have been in the portfolio and being held here. So that's the ETF model portfolios. I just kind of highlighted that. I think more investors kind of tend to look at us for sort of the stock portfolios. Those have been around longer and it's a little bit more what we're known for. But these ETF portfolios do offer a alternative in terms of something that's a little bit lower risk. If you're looking to kind of complement maybe one of the stock models with something that might control for volatility and downside risk a little bit more. And then the other screener I was going to just demo today, we'll wrap up in probably 5 minutes, is our ETF screener. And there's a couple of different things that you can do to screen for ETFs. I mean, you can do standard stuff like expense ratio, number of holdings, active share versus the S&P. But where I wanted to focus is on some of our pre-built screens. So you can search for ETFs with the highest value exposure, value and momentum, which maybe even is mostly value now, just because value, especially small cap value, has been doing well. But one of the things, like for example, like within the market today, quality hasn't really participated as strongly as some of the lower quality stuff over the past, 6 to 12 months. So, if you're an investor that basically wants to start to try to identify, well, what ETFs would be considered quality, but also in the, have value exposure. What this predefined screen is give me ETFs that have 80% more quality exposure and 50% percentile on value. And it brings us into, a handful of ETFs. Wisdom Tree US Quality Dividend Growth ETF makes sense. Victory Shares Multi-Factor. This looks like a momentum one. The Schwab US Dividend Equity ETF. And then coming across, you see the standard stuff. It's the assets, the expense ratio, number of holdings, active share, active fee, size exposure, value exposure, quality exposure. And these are all internal scores that we come up with based on the underlying holdings of the ETF on any given day. So we do that as well on Validea. So as you can see, there's really two things going on. There's these investment strategies based on great investors and other time-tested approaches. And that is in the model portfolios, those stock portfolios that I was showing you. And then we sort of pivoted over to the factors in terms of identifying ETFs with certain types of factor exposures for people that are interested in that. And then if the last thing I'll show you, and by the way, if people have questions, you can put some questions in the chat and I will get to those once we're done here. If anyone has any specific questions for me. The other thing I was going to show you real quickly is our My Validea, because while all this sounds good, investors need to be reminded sometimes that these things are happening. So what My Validea is, it's basically an alerting system that is set up. So you can put your stocks in your portfolio into here. to see how they score and how they basically rank based on, there's a fundamental view, there's a guru view. So this is kind of nice. It's giving you for your complete portfolio. And then the reason you see guru and pro guru is because there are 2 levels of subscription. There's a standard package and a professional package. Professional isn't limited to professionals. It's just a higher end subscription because some of the models that we run are included in the professional version. They're not included in the pro version or the standard version. And then there's also a technical view. So for your portfolio, your current portfolio, the stocks that you're either interested in or on your watch list, you can kind of put those in there and see all these different views of how your stocks score across all these different things. Then there's, if you're interested in following a particular strategy, so one of the models, one of the guru models, and you want to get updates on the latest upgrades or downgrades. So what stocks are moving on a daily basis. It might be a little much, but you'd be surprised. People are interested in that. You can set up those. You can set up my model portfolios. So here is, if you're following one or many of the model portfolios, you set these up, and we're going to alert you anyways when the rebalancing happens, but this is a little bit more focused, so the email can be customized for you as to what portfolios you're interested in following. The same with the ETF portfolios. You can put those in if you want to follow one of those, and then my industries and my countries. So this is where, you're just kind of getting more specific on industries that you're interested in and or countries that you're interested in. Oh, that reminds me. Let me just show you one other thing while I have 2 seconds. I forgot this. In the pro version, there are industry and country model portfolios. So here, this is where we're basically saying, in the technology industry or sector, in healthcare, and also in segments of the international market based on the ADRs we cover, what stocks score the best according to like a consensus score based on all the guru models. So this is, for people that are interested in more of a sector-based or regional-based approach to finding ideas, this would potentially be helpful for that. So that concludes the investment idea formalized, portion of this presentation. I appreciate everyone taking the time to stay on with me. As I mentioned to you, I think we have some subscribers on here, certainly, but for those that are active subscribers and also those that aren't, I will be emailing you so you can be eligible to receive a 25% discount to the site if it's something you're interested in and taking a free trial to and testing it out. Of course, it's not for everyone, we understand, but certainly if people are interested in sort of what we've built here and trying to find good investment ideas using strategies that are sensible and based on fundamentals and based on factors and things that work over time, this could be a nice tool for you to utilize in your investment process. So with that, I'll go over to the, I'll go back to just the home page, and then I will go over to the questions and we'll see. All right. So yeah, this is a very good question. So one attendee asks, so he received a downgrade on a specific stock held in one of the portfolios, which could happen. Because remember, we're not rebalancing the portfolios daily. We're rebalancing them on set rebalancing dates. So certainly stock scores can fall during these, outside of the rebalancing date. So the person's asking, is it a good idea to retain the position until the rebalancing day or close it as soon as I get the downgrade? I would, just generally speaking, just not investment advice or anything like that. I think it's best for investors, if you're following and getting decked up to the model, try not to deviate from it, even if the stock's being downgraded. I know that seems a little weird but I just think the more complicated you make the process, the more failure points there are. And so if it was me, I would just wait until the portfolio is rebalanced and do it that way. What's the recommended size for a $1 investment for testing a model for a newcomer? I mean, honestly, I've seen for testing, I think if it's kind of a hard question because it depends on maybe how big your overall portfolio is. But I would say if you're dipping your toe in with 10 or 20,000, that seems like a good as a test. It depends again if your portfolio, if you have a really big portfolio, then maybe that doesn't sound like a lot. But there's certainly investors that do a lot more than that. But I'm just thinking like as if you had $10,000 in cash that you want to deploy in the market, and this was appealing to you, you could allocate $1,000 to each position. And by the way, I didn't mention this, but we equally weight our positions. So in every rebalancing, the stocks are equally weighted. So in an actual model portfolio that you're running with money, you might not be bringing them back to those target weights, certainly. But that's how we do it. But I would think if you're going to start out, very ease your way in, like $1,000 investment in each position, just to get used to how the portfolio is behaving when the rebalancings happen, how comfortable you are with selling the stocks and then buying the new ones, given it's model driven and systematic. That might take some getting used to, just doing it. So that's what I would say to that. Hopefully that's helpful. So yeah, I would, there's a good question. Let me do this. Let me just do, a user is asking about the different versions of the tool. And I'm just going to log out of Validea here. And I want to show you one thing. If you go back to the homepage, this product overview section is a PDF file that breaks down all the different features on Validea. And there's a table in the product overview that will delineate the standard version from the regular version and also what strategies are in each. The other thing that you can do is look here. So all of these models are in standard. All of these are in pro. With ETFs, all of these are in standard. All of these are in pro. But I would start with this product overview because that's a good way to just do it. And you don't have to kind of piecemeal it together by looking on the site. It's all outlined in a table in there. Okay. I'll hang out for one more minute. If anyone has any questions, you can email me directly. I'm going to put my email in the chat. So it's just Carbonneau@validea.com. If I know we have some folks that maybe I'll address this in a second. I know we have some folks that came from Fidelity, and if you did, thanks for, I know because there was some questions around how the models I was talking about on that presentation could be implemented. So hopefully I've helped answer that through what we do here. Yeah, it wasn't, honestly, it's not, there's a question around the highest performing models are in pro. Can you address how you decide to price the subscriptions? So when we first developed Validea in 2003, we had one set of investment strategies, and they were more your traditional, like the Buffett model, Graham, Lynch. So they have, a longer term track record. And then when we developed the new strategies, which started, the first one was 2006, but it was from 2006 through like 2010, basically. We were developing and finding all these new investment models. Those just happen to be the ones that the person's correct that the better performing strategies, at least, so, if we were to take a timestamp today, most of them are in pro. Not all of them, but most of them are in pro. But it was just the segmentation of the product was just really based on that. It was, we had an initial set of strategies, we identified new strategies. Some of that performance was back. We had to back test it to fill it as far back as we could. Most of it's been real live model performance, but the point is that it's just the way that's just the way the performance is shaken out. I hope that helps. Do we have any stats on what kind of performance boost, if any, that monthly rebalancing achieves over holding for a year? Well, yeah, you can. So if you on the portfolio tool itself, when you go here, you can see it's in some cases it's substantial. I'm going to need to log in. So I think what you're asking is, you know, if you rebalance just monthly versus, oops, I'm sorry, guys. I'm going to log in here. So you can choose here, let's just choose 10 stocks monthly. So these are 10 stock portfolios, the monthly rebalance. Okay. And then if you do, you can compare that to 10 stocks annually. And you can see how underneath the annual, you know, not a lot of these actually do outperform. So it kind of shows you that, you know, when following systematic strategies like these, you know, for the most part, you got to be a little bit more active than just buying and holding for a year. Some of them do outperform, but some of them don't. I think they tend to work a little bit better just generally with the tax system. So that still forces the rebalance, but it basically, you know, you're harvesting your losing positions and you're hanging on to your winning positions, basically. So I think that's a little bit better than just annual. Okay, so I'll be emailing all of you guys a link if you're interested. And thank you very much for joining me. I hope everyone has a nice and enjoyable Memorial Day weekend. Take care.